board members, thanks for having me. You should have a handout in front of you that says audit presentation. And if you flip to page 1, I'll let you know that the audit went well this year. We had an unmodified or unqualified opinion, which means we think the numbers in the financial statements are materially correct. We did have one finding in the back of the audit report, and any significant findings we put in the audit report. If you look at page 110, you have that thick document somewhere, and it really dealt with social services. They report their expenditures to the state every year. Then you are reimbursed based on those expenditures. They over-reported expenditures of about $120,000. You got over-reimbursed. They caught that in a subsequent month, but because it happened during the year, we put it as a finding in the back of the audit report. And we did talk to them about it and let them know they need to reconcile what they spend with what they report to the state going forward. Primarily because you had a lot of turnover in staff up there. It wasn't anything done with intent. Rather, it was just a turnover issue. If you look at page 1 in the audit presentation, and I'm just looking at the general fund here, giving you an idea, going back to 2010, coming forward to 2017, kind of what your revenue growth rates were, what your expenditure growth rates were. Revenues grew at an annualized rate of 2%. That's probably a little high because in 2017 we had a revenue sharing payment of $1.4 million, I think related to Flying J, if I remember correctly. And then you got a $2 million trail grant in 2017. So that annualized growth rate, if we start taking out one-time items, it might be a little less than 2%.
Artificial.
Yes, artificially high. On the expenditure side, same thing. We've got $2 million for trail construction and $1.4 million payment to VDOT for revenue sharing. So that expenditure growth rate of 1.98% is probably artificially high as well. Typically we see, that being said, we typically see expenditure growth rates between 2 and 3%. So your expenditures are very much being held in check. Of course, your revenues are too. We just don't see growth. It's almost a mirror image of the last presentation I gave you, our presentation from a year ago. There's no revenue growth, but at the same time, we don't have expenditure growth. So at the end of the year, the change in fund balance, we had a slight decrease of about $300,000, but we still have a healthy fund balance at $9.5 million. The next two pages just graph out, pages 2 and 3, just graph out your general fund revenues and expenditures. The two items you'll notice on revenues that spike up in 2017, in federal aid, you got a trail grant, it was about $2 million. And then you had revenue sharing payment that was posted to miscellaneous revenue of about $1.4 million. Other than that, you can see that your revenues are pretty consistent year to year, no real growth there. And the same thing on the expenditure side, which is the next page, page 3. The two items that spike up are related to the trail construction and the revenue sharing payment to VDOT. So your expenditures are staying very consistent from year to year. And again, we don't see that very often. You guys are doing a good job of keeping your expenditures in check. It's very unusual to see expenditure growth rate as low as you have. Pages 4, 5, and 6 give you the same information for the school fund. They've actually seen a decrease in revenues since 2010. Annualized decrease, the annualized, this is growth rate, but it's really a rate of decrease, is negative 2.32% on the revenue side. On the expenditure side, negative 1.52%. So they're not getting as much state aid or federal aid as they were getting back in 2010, 2011. So even though we've come out of the Great Recession back in 2010, state aid and federal aid just haven't increased for the school board. And then that's graphed out on the next two pages. Page 7, I'm just showing you your original tax assessment, and we have excluded non-taxable items. So if we got tax relief for the elderly or something like that, we've excluded that from these assessment values. Annualized growth rates, you can see for real estate, 2.91%. Of course, since the, reassessment back in 2007, the assessment year 2007, real estate's remained fairly consistent year to year. public service is really the one that's grown over this look-back period, an annualized growth rate of 4.82%.
Why would that grow? State change rate?
No, the state does those assessments, but that's going to be power companies, water, railroads, things like that. I don't know if they put in something there that's fairly large in the last couple of years, or 3 or 4 years ago. But the state does those assessments.
Some of the changes in assessment valuation in West Rock has transferred from machinery and tools to public service.
Anything related to that boiler?
That makes sense because you see that machinery and tools actually went down there in 2012, 2013. Page 8, we're just showing you some key figures here. Fund balance up at the top is kind of highlighted in blue. At the end of the year stood at $9.4 million, and that's a healthy level. So even though we talked about relatively flat or flat revenue growth, you still have a healthy fund balance. The drop-off in 2011 was because you paid off some debt. I want to say about $9 million in debt and a lump sum payment. So it's nothing bad there. In fact, you saved yourself some interest costs going forward. So I think that was a good move. Total long-term obligations, we've got them listed up there, and then we have them graphed out below. The one thing I want to point out here is we started including your pension liabilities back in 2014. Before 2014, pension liabilities weren't reported in your financial statements. A new standard came into effect, and we now record those as long-term obligations. So you do see a spike up in 2014 for the general county's long-term obligations, and you see a big spike up for the school board's long-term obligations. Their pension liability at the end of the year is about $22 million. So there's money set aside to pay the teachers' pensions when they retire. There's just that $22 million is the gap between what they need and what's been set aside. And you can see it came down a little bit from 2014, but it's certainly a long-term project for VRS to get that liability under control. What that means, just in general terms, is that contribution rates for VRS are going to be high for an extended period of time as they try to rein that in.
Why is there NA in 2017 on state average?
We don't have that data yet. Yeah, we just don't have it yet. That report will probably come out sometime in late February or early March. We also, same thing for 2012 through 2014, the state just didn't produce that data for us, so we've got 3 years in there with no data. But your long-term obligations per capita at $3,000 compared to last year's state average of $7,000, so your debt levels aren't that high, even when you take into account the pension liabilities compared to other folks across the state. And I'm just looking at counties, but I will let you know.
That is an average of all counties.
That's an average of all counties. I will let you know that as you get towards the more urban areas, they tend to have higher debt per capita. And they have the ability to pay it too. They just, higher income levels as well. The next 3 pages, I think 9 through 11, that's our letter to those charged with governance, and you guys get the boilerplate letter. It does talk about significant estimates in the audit report and significant disclosures in the audit report. But this is a letter that we would tell you about those things, but also if we came in to do an audit and folks just didn't work with us, they hid things from us and did something bad, this is where we would report that to you. You guys get the boilerplate letter because we didn't have any problems with the audit. If we asked them for something, they got it to us as quickly as they could. So the big estimates and disclosures primarily revolve around those disclosures on the pension liabilities and how they're calculated. And I think we talked last year that the state currently uses a 7% discount rate, which effectively means, which is a huge disclosure, because that effectively means when you send money to the state for your pension, they anticipate or estimate that they're going to earn a 7% rate of return every year on that money. If you change that to a 6% rate of return, then your liabilities go up significantly. If they earn 8% on your money, then your liabilities go down significantly. So it talks about a little bit of that in here. And then the last 2 pages, pages 12 and 13, Our management comments from the audit, I won't go over all of these. If we have a significant finding that has to be reported, it goes in the audit report. And of course, we had one, I mentioned that earlier. These things are like somebody didn't complete their annual disclosure form. We're required to report that to you. But again, it's not, I don't think it's a big deal if they forgot to check a box or they missed that deadline by a day or two. The big thing here, as you look through here, we did have a number of issues at Social Services, and I think that dealt with just new staff. They came in cold, and we just didn't have a transition period. The folks that were running it before, when they left, we just didn't have time, didn't have any overlap. So I did talk to them, and I know they're going for training or trying to work with other agencies in the area to try to learn what they're supposed to be doing and how to document things. But you can't just pick it up overnight. It takes time. So, and they seemed like they were really looking towards getting it. And I'll kind of stop there. Spit out a lot of information, but try to answer any questions that you have. And
it's a lot to digest. I'm sure individual board members have any questions, they could contact you or John.
Absolutely. And if they have questions about the presentation or the audit report, it's 110 pages long this year. So as you digest that, don't hesitate to give me a call or send me an email with questions. And my contact information is on the front of the handout.
Board members have any questions, comments?
One comment I have is fund balance. It seems to be going down every year. I don't know where we should be. So you say it's okay, but we've gone from over 2012, 2013 from 12 million down to 9.4. That's a pretty good hit every year on that.
Yeah, I'm
$300,000 fund balance last year.
Yeah, fund balance dropped about $300,000 last year. It actually grew a little bit in 16. I'm going to give you an idea of where you need to be real quick. That's a good question. What I'm doing is I'm taking the general fund budget, expenditure budget, 35 million, the school fund, say 25, 26 million, add those two together, $60 million, and then I subtract the transfer between the two, which is probably about $10 million, I think, memory serves. 11 million dollars. So when I do that, I'm at $49 million. I take 10% of that. That's the minimum you ought to have. So if fund balance gets close to $5 million, we got to talk. But that's the minimum. If you think about it logically, with the two budgets together, 10% of them, that's enough to operate for 5.2 weeks or 52 weeks in a year. So at $9 million, you have a healthy fund balance. 9.4, you have a healthy fund balance. If you see it dropping, and once you hit 6, or if you hit 6, or if you see a trend downward, you're going to have to take some action, because once you get below 5, you just don't have enough cash flow. You can run into a bind. So I hope that answers the question.
Alleghany County's never gone to the twice yearly payment of taxes, which we all know basically is just a cash flow band-aid that people can use. How many localities still left in the state that haven't cashed that check in?
There are a number of them that haven't cashed it in. It's hard for me to say off the top of my head, but you're right, it is a cash flow band-aid. It buys you a year or two.
It's an insurance policy. You hope you never have to cash in.
Exactly. But it buys you, in most places that go to it, it buys them a year or two before they have to do a tax increase. But it doesn't solve your overall cash flow problems. And that's saying it's a band-aid. You know that. I'm glad you said that.
Well, board members have any questions after they digest all of this. I'm sure Mr. Stone or Mr. Langford, either one, would be glad to explain it to you.
Happy to do it.
Thanks for coming.
Well, thanks for having me.